Good morning. Today is September 20th. Let's get started. I'm going to overlap the last part of student and then Chairman Bernanke's discussion. Amid the dispersion of cheap credit in the years preceding the housing crisis, there was a bipartisan push for American homeownership, originally spearheaded by President Bill Clinton and later carried on by President George W. Bush. To what degree could it be argued that aggressive government policy supporting increased lending during this period contributed to the eventual erosion of credit standards on behalf of the mortgage originators? Chairman Bernanke, that is a very good question and another controversial one. Certainly, there was some pressure to increase homeownership. There was the American dream aspect of owning a home and so on. Homeownership rose during this period, but to put all the responsibility on the government is probably wrong in this case. Most of the worst loans were made by private sector lenders, then sold for private sector securitization. That is, they did not touch Fannie Mae and Freddie Mac. For example, they went directly to investors. Fannie and Freddie did acquire some subprime mortgages, but actually that was a little bit later in the process rather than at the beginning of the process. But clearly, the private sector, without any encouragement from the government, was a big player in the decline in mortgage underwriting standards and in the selling of bundled mortgages to private investors. Student, I think one of the hallmarks of the Fed under your leadership has been your commitment to transparency. All of us in this room are beneficiaries of that policy, but I wonder whether you think too much transparency could actually damage the central bank's credibility if it gets things wrong. Generally, I agree that transparency is very important for at least a couple of reasons. I talked already about the importance of a central bank being independent, so there is one linkage there. But if a central bank is independent and making important decisions, that affects everybody, then it has to be accountable. People have to understand what it is doing, why it is doing it, and on what basis it makes its decisions. So, for democratic accountability, I think it is important for the central bank to be transparent. I testify all the time. I give speeches. I have town hall meetings and other kinds of meetings like this. I give press conferences, and I think it is very important for me to explain that the Fed is doing and why it is doing it. The other reason for transparency is that over time, there has been increased understanding that most of the time, transparency can make monetary policy work better. So, for example, if the Federal Reserve communicates that its future actions will be X or Y and conveys that information to the markets may respond by building those expectations into interest rates, which may have a more powerful effect in the economy. So communication also reduces uncertainty and helps increase the impact of monetary policy in financial markets. Student, my question concerns price stability and inflation expectations. you mentioned that the importance of macroeconomic stability and long-run economic growth. Given the massive amount of liquidity that has been pumped into the market recently, how has the Fed been able to keep inflation expectations so low? I think we owe something to my predecessors, Chairman Volcker in particular, and also Chairman Greenspan, who got inflation down low and kept it there. People get used to what they see, and in a world in which inflation remains low year after year, people become more and more confident that the central bank, the Fed, or whoever will meet its mandate of keeping inflation low. It has been very striking that even though we have had movements in oil prices and other shocks to the economy, deep recession and financial crisis throughout most of the period, inflation expectations have been very well tied down to about the 2% range that the Fed is trying to hit. That might be an outdated idea, I would say. So these days, there are other stream of papers or ideas that indicate that the low inflation or missing inflation could have been a structural phenomena of the economy. So, anyways, Lecture 3, the Federal Reserve Response to the Financial Crisis. Today, I want to talk about the Federal Reserve response to the financial crisis. In the last couple of lectures, I mentioned the key theme, the two main responsibilities of central banks, financial stability and economic stability. Let me turn it around and talk about two main tools. For financial stability, the main tool the central banks have is lender of last resort powers by providing short-term liquidity to financial institutions, replacing lost funding. Central banks, as they have for a number of centuries, can help calm a financial panic. For economic stability, the principal tool is monetary policy in normal times that involves adjusting short-term interest rates. Today, I will discuss the intense phase of the financial crisis in 2008 and 2009. And so I will focus primarily on the lender of last resort function of the central bank. I will come back to monetary policy in the final lecture when we talk about the aftermath and recovery. So, last lecture is the most important lecture then. Last time, I talked about some of the vulnerabilities in the financial system that transformed into a crisis, the decline in housing prices, which by itself seemed no more threatening than the decline in dot-com stock prices. Because of these vulnerabilities, the decline in housing prices led to a very severe crisis. The vulnerabilities I talked about last time were private sector vulnerabilities, including the excessive debt taken on perhaps because of the period of the Great Moderation. Very important, the bank's inability to monitor their own risks, excessive reliance on short-term funding, which as a 19th century bank would tell you, makes it vulnerable to a run as short-term funding is pulled away, and increased use of exotic financial instruments such as credit default swaps and others that concentrated risk in particular companies or in particular markets. Those were the vulnerabilities in the private sector. The public sector had its own vulnerabilities, including gaps in the regulatory structure, important firms, and markets did not have adequate oversight. Where there was adequate oversight, at least by law, sometimes the supervisors and regulators did not do a good enough job. For example, not enough attention was paid to forcing banks to do a better job of monitoring and managing their risks. And finally, an important gap we have already begun to look at since the crisis is that with individual agencies looking at different parts of the system, not enough attention was being paid to the stability of the financial system as a whole. Let me talk for a moment about another important public sector vulnerability, the so-called government-sponsored enterprises, GSEs, Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are nominally private corporations. They have shareholders and a board, but they were established by Congress in support of the housing industry. Fannie and Freddie, as they are called, do not make mortgages. You cannot go to Fannie's headquarters and get a mortgage. Instead, they are the middleman between the originator of the mortgage and the ultimate holder of the mortgage. If you are a bank and you make a mortgage loan, if you like, you can sell the mortgage to Fannie or Freddie. They will, in turn, take all the mortgages they purchase and put them together into mortgage-backed securities, MBSs, to sell to investors. A mortgage-backed security is just a security that is a combination of hundreds of or thousands of underlying mortgages. That process is called securitization. Fannie and Freddie pioneered this basic approach to getting funding from mortgages. In particular, when the GSEs, Fannie and Freddie, sell their mortgage-backed securities, they provide guarantees against credit loss. So if the underlying mortgages in those MBSs go bad, Fannie and Freddie make the investor whole. Now, Fannie and Freddie were permitted to operate with inadequate capital, so they were particularly at risk in a situation with a lot of mortgage losses. They did not have enough capital to make good on their guarantees, although many aspects of the financial crisis were not anticipated. This one was. Going back for at least a decade before the crisis, the Fed and many other people said that Fannie and Freddie just did not have enough capital and that they were a danger to the stability of the financial system. What made the situation even worse was that Fannie and Freddie, besides selling mortgage-backed securities to investors, also purchased on their own account large amounts of mortgage-backed securities, both their own and some that were issued by the private sector. They made profit from holding those mortgages, but to the extent that those mortgages were not insured or protected, Fannie and Freddie were vulnerable to losses, and without adequate capital, they were at risk. It was not just the house price boom and bust, but also the mortgage products and practices that went along with the house price movements that were particularly damaged and that were important triggers of the crisis. There were a lot of exotic mortgages, by which I mean non-standard mortgages. Standard mortgages are 30-year prime fixed rate mortgages, or different other kinds of mortgages were being offered, often to people with weaker credit. One feature that many of these mortgages shared was that in order for them to be repaid, house prices had to keep increasing. For example, you might be a borrower who would get an adjustable rate mortgage, ARM, where the initial interest rate was 1%, which meant that you could afford the payment for the first year or two. Now, after 2 years, the mortgage interest rate might go up to 3%, then after 4 years, 5%, and then higher and higher. In order to avoid that, at some point you would have to refinance into a more standard mortgage. As long as house prices were going up, creating equity for homeowners, it was possible to refinance. But once home prices stopped rising, and by 2006, they were already declining quite sharply, rather than having built equity, borrowers found themselves underwater. They could not refinance and found themselves stuck with increasing payments on their mortgages. Some examples of bad mortgages practice includes interest-only adjustable rate mortgages, option adjustable rate mortgages, which permit borrowers to vary the size of monthly payments, long amortizations, payments periods greater than 30 years, negative amortization adjustable rate mortgages. Initial payments do not even cover interest rate costs, and no documentation loans. Most of these bad mortgage practices share the feature that they reduced monthly payments early in the mortgage, but allowed mortgage payments to rise over time. Take, for example, an option adjustable rate mortgage, which is an adjustable rate mortgage with the option for borrowers to vary how much they pay. They could pay less than the full amount owed each month, and what they did not pay just got rolled back into the mortgage. The other common feature of bad mortgage practices, such as no-doc loans, was that there was very little underwriting, which means very little analysis to make sure that the borrower was creditworthy and was able to make the payments on the mortgage. Isn't it just devastating? Why were they so stupid?